they will offer you something called RSUs, like restricted stock units, as part of your salary package. $50,000 is your grant amount, 33% of the whole grant in the first year. Hey everyone, welcome back to the channel. This is Satvik. I currently work as a software engineer at Google, and today we're going to discuss how Google stock units, or be it any restricted stock units, work. And let's get started. Okay, so a lot of the times when you're joining an existing listed company, right, they will offer you something called RSUs, like restricted stock units, as part of your salary package. Now, this can feel a bit like paper money and it can be a bit confusing. So that's what the purpose of the video is, to go from what they are to how they end up in your bank account. So I'll take my case as an example, which is more or less a standard way of how these things work. So alright, coming to the first step, the grant. So this is part of your salary package, and this is what is initially offered to you. So this is a grant of stocks that will be vested to you over a dedicated period of time, which will be told to you during your onboarding. And the grant is basically, let's say they want to give you an X amount of grant. Let's say $50,000 is your grant amount. And they want this money to be given to you in the form of stocks, right? Stocks of the company that you're joining. Now, what happens is, let's say you're joining in January, and they want to give you an X amount of money. Now, how do they define the value of the stock they're giving to you? So usually what they do, and also this is the case for Google, what they do is they take the previous month's average stock price. Let's say that is 100 rupees, $100. Now that X amount of money, which was $50,000, now if we divide that by 100, we get 500 shares, right? So your grant is of 500 shares, and now that grant will be vested to you according to a vesting cycle. Okay, so now let's come to the vesting schedule, right? Like how you earn this equity over time. Now, a lot of these companies will have 4 years vesting schedules, 2 years vesting schedules. So in this case, just for an example, we'll take a 4-year vesting schedule. Now, what happens is, and a lot of these corporates will also have a front-loaded vesting schedule, right? What this means is that they try to make the offer more lucrative for employees. So what they'll do is they'll give you 33% of the whole grant in the first year. Then they'll again give you 33% in the second year, and the rest is divided in the third and fourth year. So that just lets the employee say that, okay, I have an X amount of package in year 1 and something like that, which is just, I guess, a way of employee retention. So 4 years, and in those 4 years we have 33, and then those two divided equally. Now, in these 33% in the first year, what happens? Again, companies will have different things. They will have quarterly vesting, they'll have monthly vesting, they'll have yearly vesting. So in the case of monthly vesting, those 33% divided by 12, what that amount is, you will get every month those amount of stock units. Again, in quarterly, you'll divide that by 4, and then same case for the year, then you'll get the entire thing at the end of the year. So that is how the vesting schedule works. Okay, so another important topic, right? This is one thing that me and one of my colleague, we were talking about recently, that he asked me that, yaar, ye stocks aate kahan se itne sare, right? And that is something that I wondered as well, right? And which is probably the motivation behind this video, is that what is the source of all these stocks, right? Because, okay, there are stocks that are being traded in the open market. Then these are the stocks that employees get. Now, like, for example, companies like Google, Microsoft, they hire so many candidates each year. For example, Google, right? Every 2-3 months, they have a fresh batch of employees coming in, and everybody is getting new, stocks. At least the tech employees, as far as I know. So that's what you were wondering, that how do they give out so much stocks? Is this like paper money? Is this what they're just printing new stocks and handing it over to you? So that is when I did a little bit of research, and this is what I found. Okay, so this is what I found, right? Let me introduce you to the concept of dilution. So what dilution in this context means is that whenever the company issues new shares, right, or whether they buy it from the open market or they issue new shares to the employee stock plan to give out to employees, there is a dilution that happens in the value of the existing share. But you will see that, Google, let's say for example, hands out so many shares every year to employees, but that doesn't affect the stock price, right? Because what happens is that they've already factored it in as kind of like a business cost, just like salaries, right? they've already factored that in, and it is already adjusted in the stock price. So you will see that me getting or some other Google employee getting stocks doesn't really affect the stock price itself, right? So it's like kind of like a business cost that has already been analyzed and refactored into the cost of the stock. So that is why it doesn't affect the stock. Okay, so think of it like a pizza, right? If there is a new person and I want to give him a new slice of pizza, there are two options that I have. One is either I buy it from somebody else and give it to him, or with the permission of everybody at the table, I just use one of the existing pieces, I cut it up into a small piece and I give that new piece to the new person. So what happens, right, in this case is the value of the entire pizza, which is the company itself, is growing at such a fast pace that the value of the small pizza slice that I created is still greater than what it was yesterday, which is the price of the bigger slice. Okay, so basically the conclusion is the dilution of employee RSUs, right? They're already priced into the stock price that you will see on the stock market today. Like analysts and everybody that research the company, they already know that this is a standard practice, and in the year 2025, Google will have, an X amount of expense giving out stock units to employees. So that is already factored in. So that is why it doesn't, really affect the stock price when new employees come in and they get a certain grant. All right, so now let's move on to the next part. How RSUs are taxed in India, right? Unfortunately, all the stocks that we get are not what end up in our account. So what happens is, so it's quite a simple thing. So RSUs, the RSU income, what they're worth, right, is by default taxed at the source as your salary, right? So whatever bracket you lie up in, it is taxed according to that. Once the stocks are in your account, right, and let's say down the line, 2 years down the line, you are planning to sell them. Now again, you have to pay a tax when you sell them, which is the capital gains tax, if obviously you sell it at a profit. If you sell it at a loss, then you will be able to offset your total income tax using that loss. Okay, now this part is more or less for the people that receive these stock units of companies from other countries, not particularly India. So this is about like how you will bring that money back home, right? If let's say you're getting these stocks in a USD currency or some other currency, how do you plan to bring these stocks back to India and convert them to INR in the best way possible? So you sold your shares and you have USD sitting in your brokerage account, right? Now how do we get that money back to India and convert it to INR, right? So there are three main options and each has its pros and cons. So the first and the most easiest option probably is if you let your broker convert it, right? So now let me explain this. For example, if you have your brokerage account in Morgan Stanley, for example, they'll have the USD in their account. Now, if you just tell them to wire that money as INR to your bank account in India, they will take that USD, they'll charge a 1% transaction fee, something like that, and they'll convert that to INR and give it back to you. Now, this is a hefty transaction fee, right? This 1% compared to others, which we'll discuss. This is quite a lot. Okay, and one doesn't usually sell these stocks quite frequently, right? There's something you sell in chunks whenever you need them. So a 1% fee is quite a lot on that. So let's move on to the second way of doing this. Okay, so before we move on to the next two ways of getting your money back to India, right? I want to introduce you to a term known as the IBR, also the interbank rate. Now this is the rate that banks trade currency at, right? So this is the rate when you Google USD to INR. Let's say it pops up 83 rupees is 1 USD. So that is the rate banks trade these currencies at. So when you want to convert these currencies through these banks, they'll often charge you some convenience fee over this, right? So that's about interbank rate. Now let's move on to the second option of getting your money back to India. All right, so the next option is using middlemen forex services like Oz Forex, which is also known as OFX. So let's say that the USD to INR rate is around 83.5, right? So what these guys will do is what they'll offer you a rate at which they'll convert your USD to INR, which can be 83.55, 83.57 or something like that. That's what their business model is, that on every dollar that they convert from USD to INR, they'll charge their own spread. And this will be less than traditional brokerage accounts, for example, Morgan Stanley or Charles Schwab or something like that. But we'll move on to the next option, which is probably the best in terms of capital. Also, one catch I forgot mentioning about Oz Forex is that they will take a lot of time to deposit your money in your bank account in India. So they take upwards of 1-2 days, sometimes, and yeah, that can be a bit of a pain. All right, so moving on to option 3, which is probably the best option in my opinion. So this is the option in which you let your Indian banks handle the conversion, right? All right, so in this case, step 1 is that you set up a brokerage account with your current Indian salary bank account. Let that be a HDFC, ICICI, Axis, whichever. And what you do is, right, you transfer USD to USD in both of these brokerage accounts. Let's say you transfer your USD from Morgan Stanley to HDFC Bank. Now HDFC Bank has that USD in your brokerage account with HDFC. So what these guys will do, right, if you have a good salary account relationship with them, is that they'll offer you very good preferential forex rates. Alright, so now what do I mean by these preferential rates? So as we discussed earlier, the IBR, the interbank rate. So what these guys will do, right, they'll offer you rates like IBR minus 7 paise, IBR minus 4 paise, depending on, whatever your relationship with them or the current offer that they're giving out. Okay, so let me explain this IBR minus 7 paise term, right? So what they're actually saying is that they'll buy your dollars and convert it to INR on a margin of 0.07 rupee, which is 7 paise. So that means that on every dollar that they convert to INR and give it to you in your bank account, they'll charge 7 paise on that. Now, as opposed to this, when you were doing this at Morgan Stanley, which was charging a 1% convenience fee, that would equate to IBR minus 83 paise, because that was 1% of the dollar, right? So that is a huge difference, like IBR minus 7 paise, 3 paise, or IBR minus 83 paise, which is literally around 10-15 times. Alright, so which option is best, right? The broker option is probably the simplest, the first option that we discussed. The OFX option is more predictable, and the cheapest option is letting your Indian banks convert it. Now it's your choice what you want to optimize for, and I'm guessing a lot of people will go for option 3. So that is why I tried to explain that as much as I could. Okay, so to recap, RSUs are a promise of stock that you earn over time through vesting. Now they are taxed as income, and they'll also be taxed when you sell it as capital gains. And you have a lot of strategic options on selling them and bringing them back to India, which we've already discussed. So do hit a like if you liked the video and if you're here till the end, and consider subscribing to the channel. It's very new, and thanks for the support. Bye bye.